Here's the host of Health, Wealth, and Happiness, Gary Posick.
Good afternoon, everyone, and welcome to Health, Wealth, and Happiness. My first guest, he's an IRS problem specialist, and today we're going to be talking about the 8 tips to avoid a tax audit.
I'm glad to be here.
Joe, I know as a tax specialist, a lot of people really get concerned about being audited, but the fact of the matter is that fewer than 1% of all tax returns are in fact audited. That's good news, but there's no guarantee that you're going to be exempted from a tax audit. But there are some things that are red flags that I guess the IRS does look for in terms of auditing somebody.
Well, yes. Actually, I like to think the percentage is higher than that because the IRS does correspondence audits, and a lot of times they'll think of it as just compliance, missing information, but in fact they increase the scope to an audit. So my numbers, what I experience, are pretty high for the amount of audits that they do. And yes, there are a lot of things that people do that if they didn't do, there's a lower chance that they would be audited. I'd like to go through some of those, and then I want to give people our method for not being audited. I have a 4-part item list that in the past, anyone that's followed these 4 things has never been audited.
Okay.
Yeah.
That sounds fair. Okay, in your opinion, what is the number one thing you think that the IRS looks for in terms of calling up to let you know you're going to be audited?
Well, it's a combination. One is their matching program. People that don't get the records of the W-2s, 1099s, K-1s that are filed on you, what happens is the IRS matches what you have on your return. So if you don't match those numbers on the return, they'll audit you right then and there. They'll think you're not reporting income or you reported things incorrectly. So that's one really big one. Another one is the return has to make sense. There are people that put down husband, wife, 3 kids, and they only made $20,000 with no explanation. And the IRS now has been requiring that you explain to them your situation. So we would footnote that return saying, taxpayer lived off of money borrowed from family or whatever the situation is. And that goes for deductions as well. People need to put down comments on the returns such that they understand that their auto mileage might be high or their charitable contributions, and you almost write a story to the IRS explaining to them that, hey, you know what's on the return, you're familiar with the code and the regulations, and you have the receipts and documentation and third-party documentation even to verify the expenses. And a big thing that people miss is that it was prudent to deduct it. Revenue officers will look at expenses and say, well, you overspent. You didn't really need to spend that much money for entertainment or travel or vehicle. And they'll try to decide for you, what was a proper expense. So if you document your return with all these explanations, then you have a much lower chance of being audited.
So I guess the key is that if you say I gave X number of dollars and it's a high number to charities, you're fine as long as you have documentation of that.
Well, correct. And you mentioned charity, which is now you've got to actually have attached to your return a statement from an appraiser as well as a statement, with signature from the people of the charity that you gave it to. So the documentation is much more substantial now than it was years ago.
So you just can't say, well, I gave $10,000 to United Way, and they used it however.
No. In fact, there's a 3-year rule that if the charitable organization doesn't use the item for its intended purpose and sells it, they have to, for example, you have a vehicle, and you give the vehicle to the battered women's shelter or something, and the fair market value is, it's a used vehicle, it might be $1,500. Well, if they get hungry for cash and they sell it for $500, they have to report back to the IRS that they sold it for $5, and your deduction will be limited to the $500 instead of the $1,500 that you originally had.
I gotcha. Yeah, well, that's good information to know. And then I think, too, many times people will donate clothing and objects in the home. It may be furniture. It may be knickknacks that they no longer want. And it's, well, you just, the charity will say, well, you fill in the blank as to how much you think it's worth. I would guess that you're dealing with a hot iron when you do that, because if you say, well, I gave to Goodwill $750 worth of used clothing, man, that's an awful lot of used clothing. You know what I mean?
Oh, absolutely. And people don't realize that, you're lucky to get more than 10 cents on the dollar, even for new items. The IRS is not very generous, and if you do give a lot of clothing, it's best that the tables get looked at for, estimates of what you can put down as value. You can have a suit you paid $300 for that you never wore, and, you're lucky to get more than $30, $40 as a deduction for it.
And the same holds true, I think, with a couch you've had downstairs in your basement that you no longer want, and so you have Goodwill come and pick it up basically just to get it out of your premise, and you put down $75 when, give me a break. You couldn't get a dime for it, you'd be lucky to take it to the dump.
Well, they're on to that, but if you keep the number down to a minimum, it's, and you audit-proof the return, then that's not likely to be a big problem. What happens, though, is people will give money, let's say, to public radio and get that weight loss CD, and they'll deduct the whole amount, and you're supposed to subtract the value of the CD that you got because you got something for it. And people forget to do that, too.
Other things that you have found over the years that will cause a red flag?
I'm very big on that documentation. What people should do is take the deductions you're entitled to. But what's happened is when people go to tax preparation companies that just read the instruction booklets or use a computerized program like TurboTax or TaxAct, they don't really have the accounting understanding and the in-depth understanding of audits. So when they do self-employment schedules for a sole proprietor, they'll make businesses out of things that aren't really businesses and attempt to get deductions. So Schedule Cs are scrutinized very carefully. Employee business expense. People, these preparers will say, did you buy any books or tools to use on the job? And put that down. And the way the auditors look at that issue is it's got to be a condition of employment. And they'll ask you, when they look at that item, they'll ask you to bring copies of your employment agreement or the agreements that the company has to see if you were forced to. It almost has to be a condition of employment that you would spend that, or they won't give it to you. So that's an area. Earned income credit also. They recently changed the rules to where you have to fill out a form, the preparer fills out a form concerning a whole list of questions, but then a year ago they changed it to where the preparer actually has to not only collect Social Security information, but ask questions about the situation. Are these really your kids? And so people have to be very careful. Even if you're legitimately claiming the earned income credit, because it's a big target of the IRS, as well as office and home. Some people qualify if they have an office and home, but just because you have an office and home doesn't mean that you qualify. So I always recommend that people hire a licensed professional firm, a licensed professional law firm or CPA firm. We're licensed by the state. And if you don't, you're not under the board rules. And there's a lot of companies out there that claim they have attorneys and CPAs on staff. But if the firm is not licensed, you don't have that assurance. And it can be very dangerous. Most of those companies have a lot of lawsuits and internet complaints against them. But I want to say that, actually, if you just Google Killer IRS, you can get to my website. I have a very valuable free download that explains how to deal with collections and the IRS. And people should not be, and I can't emphasize this enough, people should not think that they're safe just because they have their receipts. What I recommend my clients to do, if you absolutely do not want to be audited, the first thing is file an extension. All these people that are looking to get money back right away, they're quick refunds, sure, we can do that for you, but you're going to risk being audited. If you file an extension and then file it right before October 15th, the date that it's due, they've selected most of the returns for audit. So if you do that, you're in a small pool to be selected. And then that matching program I mentioned, by the end of August, beginning of September, they have all of that on record. So you get that information. We can get it for you, or you can call the IRS and get it yourself. And you match that information number for number on the return. And then you won't be subject to audit for the matching program. And then the last item, which is the big key, is what I was explaining about documentation. You can't just say to the IRS, I have my receipts. You have to first show them that you understand the rules. You make a statement. Taxpayer understands the rules involved. Taxpayer understands the vehicle mileage might be high in relation to the income, but taxpayer can show that it was very prudent to incur, very important to say that it was prudent to incur those expenses, and they were ordinary and necessary expenses to operate the business. If they weren't ordinary items, explain that. But if you put a bunch of explanations on the return and you're letting the IRS know that you understand the rules and you understand how they think and you understand the level of documentation, that you have statements from third parties to back up, like auto mileage, that they don't trust us as taxpayers anymore. If you bring your vehicle in January to be repaired and the service center puts down the mileage, and then later on in the year you bring it in and they put down the mileage, the IRS will use those records to estimate the amount of mileage you drove for the year. So they look to seek toward third-party documentation. So if you do that, if you file an extension, you file it right before the 15th, you match everything from their wage and income transcript information, and the return is documented. We don't know one person that did that was ever audited.
Good advice. And we're going to take a break, and we'll come back and talk about others, Joe, because I think this is important stuff. And when we do come back, the first thing I'd like you to talk about is why most Americans are so in love with getting a big refund. I mean, you hear people talking all the time, just as happy as a kid in a candy store. Guess what, Joe? I'm getting a refund of $1,316.12, and they're besides themselves. We'll talk about that right after this. giving us tips on how to avoid a tax audit. And Joe, I asked you before the break, what is this all about? And America's love affair with getting a big tax refund.
I don't know if it's strictly American. So when you think about it, tax time comes around, and a lot of people have a lot of work to do, putting all their information together. Then they have to pay somebody to do the return, and then they pay the IRS. They don't get to take a TV home or anything. It's a lose-lose situation all around. So if you don't have to pay, you're ecstatic right then and there because you're not paying any money. And then if you get a refund, it's like found money. But to me, most of the enjoyment is you didn't have to pay. People shop returns sometimes based on who can reduce the amount of money. I get calls from people to my firm saying, well, I went to this guy and he's got me paying $12,000. And then he went to someone else and they had him paying $5,000. And he wants to know why there's such a big difference. And I wish people would think more in terms of audit protection and following the rules, because these extra deductions that are not according to the rules, and some of those pitfalls I mentioned, phony Schedule Cs and things like that, by the time the IRS gets through with you, by the time they add up all the interest and penalties, and fraud penalties can be an additional 75% of what you owe, you're sorry you tried to, get the biggest refund in the first place.
Well, isn't the idea, maybe I'm wrong here, but I've always thought that the idea is come as close to zero as possible. In other words, you're not getting a refund, but you don't owe anything. Isn't that the idea?
You're the second radio host that said that today. I guess it is for a lot of people. I mean, you don't want to give the IRS extra money, so if you get a huge refund, you can cry about all the interest you lost, leaving the IRS holding your money. And then if you pay, you may have penalties on top of it. So, that's why you want to keep it close to zero, because it's the best use of your money. But you really want to, you can't always do that. There's a lot of commission people. I've got some real estate people that they have transactions that went through in December. Well, they're supposed to make the estimated payment January 15th, but if you don't do a mini tax return to figure that out, you can only guess at what your liability is. The answer, of course, is download a free Tax Act program on your computer, put your numbers in, make up a little mini return that looks as close as you can get, and before January 15th, it's past that now, figure out if you're going to owe, and if you owe, pay it right away. But most people don't do that. That's what they go to my firm, Joe Mastriano, PC, for, to do those type of calculations.
Well, I think there are a couple of things. First of all, with the tax code changing every year, most of us don't have a clue as to what those changes are, don't want to bother with it, and do go to a CPA who does know, whose business it is to know about the changes. And I've always felt like going to a CPA who understands the tax code, they pay for themselves. I don't care what it costs, $300-400. Let them have the money. They'll make it up in what they know.
Exactly. That's the way it's been for years, and that's normally the price we charge for a return, except for people that want their money, they have this bank product thing, and people want these huge refunds, and they want it right away, and they're willing to pay an extra $150 just to have the bank fund the money first ahead of the IRS. I think it's crazy, because we save our clients the headaches and the money of being audited, and we save them by getting them the right deductions. Like I said earlier, I'm not afraid. I don't believe in worrying about red flags. Take your deductions you're entitled to. just document the return and let them know up front that you're ready for them.
Well, this may be a little off subject, but I would like to get your opinion on this, Joe. As a professional that's in the business, we've heard so much lately about identity theft and electronically filing your taxes. That you file your taxes, you're waiting for a refund, only to find out, well, I'm sorry, you've already filed your taxes and the refund's already been sent out. And you say, no, not me. Well, yes, sir, here's your Social Security number, and that was sent out 3 weeks ago. What's your take on all this? Should you e-file or should you not?
No, you should. Well, the IRS requires e-filing. In fact, for tax preparers that file more than 10 returns or something like that, we're required to e-file for our clients. That's not the problem. The problem is the actual identity theft that that the IRS hadn't been policing that. It's unfortunate that the IRS now has changed. They used to do returns for people for free. They would provide a return service for the elderly and poor that couldn't afford it, but now they don't do it anymore. And President Obama, publicly announced that, well, we're diverting a lot of our resources towards stopping identity theft. I agree with them. You need to do that because it is rampant, but there's nothing a person can really do about it until it happens. E-file, do the normal things you can. Don't, send your Social Security number or credit card number over the Internet unless it's part of a secured document. Secured websites tend to have that S on the URL name, so you don't want to send that information unsecured. But you find from time to time, my broker tells me, and now my credit card company says, well, Walmart and Target and this other company, we want to put you on notice that the credit card numbers have been compromised. And you can't do anything when that happens. So if you do hear from the IRS, and we've had a few cases last year, and actually none before that, if you do hear from the IRS, they have a program set up specifically to deal with identity theft. I suggest people, call me, 713-774-4467, and we'll talk about what to do. But if you give them the right information and work with them, you won't have to worry about it. The cases we had were all cleared up in the favor of the taxpayer. You just have to be patient.
Great advice, because I think most people think, well, I guess I'm just screwed, and that's not necessarily true in what I'm hearing you say. But here again, it's knowing the proper way to communicate with the IRS, and that really is what you've been saying for the full half hour of today's program. It's knowing how to communicate with the IRS. If you do it the right way, you're never going to get audited, ever.
Exactly. And it goes for collection cases as well when you owe money. We have a 5-part program of getting a status code and certain filing and paying on time. And if you follow that, they can't touch you. I know of no cases out of thousands that I did since 1980 forward. I know of no cases where the IRS was able to take collection action when all 5 of those things were in place. So
well, common sense tells me, Joe, that, if you owe money to let's say you end up and you owe money to the IRS, aren't they going to work with you to make sure that you can work out a payment plan to pay them back? I mean, everybody thinks, oh my God, I owe them $4,312. I'm going, here I go to Leavenworth, Kansas, send my mail. I know this, if I'm in prison, I ain't making any money. I would think that the folks at IRS, they figure that out too. So aren't they going to work with me to set up some kind of a payment plan for me to make up what I owe?
Yeah, yes and no. Under $25,000 is a small dollar case. They have the authority to put you in an agreement without taking financial statements. So theoretically, you can call up automated collections and tell them how much you make and spend, and without even sending documentations, they can put you in a payment plan. However, what they don't do is tell you what you can do to break that. So they'll put people in payment plans that owe money on their 2013 taxes. And then they file their returns. Let's say they filed in April and didn't follow my plan. They would break the installment agreement once that new liability came out. And so they don't coach people properly on what to do not to break the agreement. And then when you get larger cases that are more than $25,000, a lot of times it depends who you get. It's the luck of the draw. You might get a very nice revenue officer or automated collections person that's willing to work with you, and then your only choice would be to download my free download, which actually tells you the 5 things that need to be in place. Just Google Killer IRS. You'll get to my website. And I mean that sincerely. This is not a sales booklet. This is a 74-page document that actually tells you step by step what we would do to protect you from the IRS. And if you follow that, you'll be fine. But if you've got a bigger case, even, they make up the rules as they go. And the collection divisions, even locally here, the managers who I know very well over the years, it's like night and day. Some managers are good and some aren't. Some police the people under them and others don't. And so you might get unlucky and get some renegade revenue officer that's really going to give you a hard time, demand you give him $20,000 in 3 days, and there would be a reason to be frantic. So it just depends. That's why I never recommend people. I have attorneys as clients. Some of them are partners in large law firms. I have some CPAs and accountants as clients. Some of these people know the tax law better than me, but they hire me because of the expertise in dealing with the IRS personnel, the audit division, the collection division. It's very specific knowledge. And as long as it's been that way ever since I've been in practice, they haven't changed it. Those same rules about status code and filing and paying on time according to their own rules still exist. Great example. You think your monthly payment's due on the 15th, so if it's postmarked by the 15th, you're okay. But no. Special rules for collections. The payment must be logged into your account at the IRS by the 15th. So they don't tell you these things, except occasionally.
So you have to know how to play the game, and you got to know who you're talking with, which is, that sounds like Russian roulette.
Yeah, I never recommend that people do this on their own. Years ago, I was foolish. I had sent clients to the IRS themselves to deliver documents thinking that, that was pretty safe. And they used to be cornered by them and threatened. And now I have to keep my clients away from the IRS because they'll bypass the power of attorney. They're not allowed to do it, but sometimes they will.
For those people who think they may be in trouble or have a problem with the IRS, Joe, please give a way in which they can get in touch with you.
The website is taxproblem.org. I have a trademark. It's Killer IRS. So if they Google Killer IRS, my website will come up, or they can just call me directly at 713-774-4467.
I thank you so very much for coming and sharing on Health, Wealth, and Happiness.